I cannot go more to these presentations because I end up buying more shares of Salamar, so I will stop listening to these guys. But it's very good because we have 15% of the classic, which is our value fund in salmon, and between 15 and 20% of the natural resources in this company. Salmar is one of the biggest. And we have been buying this year and the past year because prices have been low and shares were down. So we are very happy to hear that better prices, better margins, better cash flows, and we should make a ton of money here. Okay, so this is important because then I touch more or less 20% of the natural resources. I will present on another 20-25%, which is oil exposure. Then I will present on another 20%, which is copper. So with this, more or less, I touch 2/3, 70% of our exposure in the natural resources. So with oil, I'm going to use the same structure because we focus on supply. Most of the market focus on demand, Trump, monetary, the Fed rates. We focus much more on supply because demand, both in oil and copper, is very, very stable long term. So we don't waste of time, although I'm going to touch a little bit also on demand. So in oil supply, I have divided the supply in two parts in order to understand what is going on. First, the fundamental challenges that I summed up in 4, because we don't have time to go through all of them. But there's a problem with declines. So I will enter later on the investment since 2013, investment barriers with ESG, CO2, electric transition. And then there's a fear of peak demand, which everybody has. Everybody thinks now that the demand of oil is going to go down. Well, it's not going to go down. Declines, just one slide to touch a very, very technical thing. But basically, if you try to estimate the decline of the wells, you know all the wells from first oil, first year, 2 years, depending on the well, you reach peak production, and then a plateau for a number of years, and then you get a decline. As the average of the world is in decline, you need to guess what is the average decline, and the estimates are very broad. But my kind of rough numbers is OPEC plus, which is more or less 40% of the supply. I use a low number, 2%, 50% for non-OPEC, non-shale. I use 5%, which I think is fair, and for shale, I use, which is 10% of the supply of the world, I use 20%, the average is 5%. So every year, due to the decline, we need to replace 5 million barrels a day, which is half of Saudi Arabia, half of shale oil every year after year, and we are not investing. And this is getting worse. Shale oil declines are higher, and it's more and more of the total. Giant fields are aging, and then we are using a lot of EORs, enhanced oil recovery, which we don't read about, but we are kind of investing a lot in taking the oil earlier, rather than investing in new fields. And this is the other problem, chronic underinvestment. So this is not new for anybody. The maximum was in 2013. Since then, was down to more or less COVID. Then it's a bit up. This year is kind of weak. Next year is going to be down if oil prices stay this way, which means that we are not really at the level we should be. And, we've been living on shale oil. Shale oil entered the market in 2012, 2013 on a meaningful way, and it's been 2/3 or 70% of the growth for the last 10 years, and now it's maturing. So we need to look to what is the next shale. Then we have ESG. Obviously, everybody wants to get rid of fossil fuels. They generate CO2, they generate sulfur, they pollute, they are dirty. We want to be clean. Then there is resource nationalism, so every country that has oil or gas or whatever they want for them and for their allies. And then fiscal, in the UK, which is a free country, they raise their taxes from one day to the other day from 50% to 80% to oil, to the oil industry, which is fantastic. And who is going to invest in an oil field which is going to cost 1, 2, 3, 4, 5 billion? It's going to take 2, 3, 4, 5, 6 years for first oil, and then you think that demand is going to go down. So these barriers are changing the dynamic here in oil. Really, investments are depressed. And this is probably the worst, and very difficult to put a number here, is the fear of peak demand. So the narrative is clear. Climate change, we must act fast because it's warming. We need to get rid of fossil fuels. This is the narrative. Everybody buys it. The public opinion buys it because it's easy. Electrification is the solution. All the politics, banks, as they know that the public opinion is there, they go there. Everybody's green. And then, you know, as we are electrifying everything, we don't need oil. And if we don't need oil, we don't invest. That's the narrative. What is the reality? In our opinion, we may debate on this, but electrification will take decades. This is our conclusion, our opinion. Energy demand is growing massively. Oil demand keeps growing. We'll go later there. We will need oil and other fossil fuels, not for years, for decades, for many decades. So we must invest. And if we don't invest, supply will go down. And as I said, even some companies changed the strategic, BP, Shell, and some others, they changed the strategy 10 years ago, saying we move from oil, we are going to invest in renewables, and now they are coming back. So that's the kind of fundamental view. Let's go to the near-term low inventory. So everybody, wow, the market is oversupply, prices are down. We're still very low in inventories. This is 8.2 billion barrels globally. And these inventories are still, if you take a step back, still in the low end. So inventories are low, they are not up. And it's amazing that, you know, OPEC Plus is back, they're bringing back a lot of production and inventories are not moving up. So something is cooking here. What happens in the US? Low prices. So this is the rig count and the the fleet that is operating the rigs and is going down. This combined with depletion, I mean, it's mathematics. Production will go down. Nobody has this in the numbers. And you can see what is going to happen with shale. So, you know, shale has peaked and is already a mature asset anyway. So basically, shale will be growing in the future with prices above $75, $80 WTI. If prices are at the current level, 60, this will go down. And this was 75% of the growth of the past 10 years. And this is just the distribution curve of the break-even oil price for the US, for shale. And if you take, you know, into account what is going on now, more or less, they need $75 WTI to make money. Let's put it this way: net present value positive. So from shale, let's go to non-OPEC. I'm focused on 25. 24 is over. On 25, you see that the United States is still is down. This year, in the figure, we see 400,000 barrels more, but it's going to be lower. Brazil, maybe 300. You add up, and this year, non-OPEC will grow much less than last year, that it grew 1.3. This year, probably, we will get, I don't know, half of it. 26 and 27, non-OPEC will go to 800 and then 400. I think these numbers are overstated. So I think these will be lower at these prices. Always bear in mind that oil production has a direct relationship with the price. Higher prices, higher production. So we cannot fix the supply-demand equation. It's dynamic. So non-OPEC is slowing growth and tending to zero in a couple of years. And OPEC Plus, yes, they have a spare capacity. Why do they have a spare capacity? Because they wanted to manage the price with the COVID. With the COVID, we had a huge crisis, and in 1 year, demand fell a lot, although it recovered very fast, but we lost almost 10% of the demand during 3 months. OPEC has cut production in order to keep prices, and they have been managing the price for the last 2 years since COVID. So now spare capacity is high, 5 million barrels, and they are bringing it back. Already they announced a couple of millions back. It's very difficult to be very accurate because the numbers, they are not transparent. So I'm giving you my best guess. And OPEC Plus, they need $80 on average. Saudi Arabia, they need $90 in order to break even their fiscal numbers. So, you know, it's in the interest of the OPEC and of Russia, which is the plus, is basically Russia, to have higher prices. Russia is funding a war. They cannot live with the oil prices at 50. It would get very worse. So, you know, there's a lot of interest on OPEC Plus to bring back the production a little bit, you know, keep Trump happy and just be near their fiscal break-even. So it's difficult to, with all this information, to get the exact number, but the OPEC Plus interest is to manage the market and have prices between 70 and 90, 70 100. This would be their best interest, in my opinion. So what is demand? That is the most controversial thing. So here we are very contrarian. So our investors know. People think that oil demand will go down, and we think that, let's go to the facts. 2010, 2015, this is 2025, sorry, is 15 years. Demand is up in the last 15 years, more than 1 million barrels a day, 1.2. So this is fact, 15 years. 25, this is a fact. Demand is going to grow around 0.9, and we are in an economic slowdown. US GDP going down, European GDP going down, China is crap, and GDP globally is 1 point less than last year. So 900 barrels, 900,000 increase in 25. That's almost a fact. 26, we have enough visibility, it's going to be more or less the same. So 900,000 is when the economy is depressed. I don't want to know what these numbers can be if, Fed cuts rates, Europe takes up, and we have a new cycle in China. That, I don't know if it will happen. Looking at 2030, I do a very easy number. I keep the penetration of global oil consumption per capita, and I keep it flat. It has been flat for 50 years. You multiply 8.5 billion people for the oil consumption per capita, and you get 108 million barrels a day, 2030. We are at 104. So it's really, we're going to be 5, 6, 7, and 8. It's going to be like this. So I wouldn't discuss too much on that. And then looking at the long term, so if you look at the really long term, historically, growth has been 1.4 million per year in the last, 20, 25 years. And here, the only way we can express it is on population. We basically calculate that out of the 5 parts of the world with 1.5 billion people, so Southeast Asia, China, India, Latin Africa, and then developed markets, basically 4 of them continue to really grow in terms of oil demand because they are, developing themselves. Out of the 4 end demand sectors, 3 are still growing: aviation, chemicals, petrochemicals, and diesel, which is basically transport, heavy transport, very difficult to electrify. And then we did a model on EV penetration in light cars, in passenger cars, and we don't reach peak oil demand until 2035. So, all this indicates that really trying to think long term, we don't see peak demand until 2035. Even if we are wrong there, the curve will be like this: boom, peak, and then a plateau. It's not going to be boom, then we forget oil. It's going to be boom, and then like this for many, many, many years. Outlook: we think we'll have a problem in supply. Inventories are low. There is enough supply in 25 and 26 for those looking for timing. This is why everybody is negative, because OPEC Plus is bringing production back. Demand is weakish because of the economy. And yes, there is a little bit of excess supply. And you know who's taking this? And nobody says it, it's China. China is building inventories, and they're building also capacity for storage. So we'll see if this continues or not. So we need incentive prices in order to incentivize supply in the next few years. Prices will move much higher because bringing this supply is not a matter of 2 years. It's a matter of 5 to 10. So we will have first a spike in prices. We don't know if this will generate a crisis. This could happen. And then, back to incentive in order to have new supply meeting demand. Sector is massively cheap. Everybody is bearish. And then, shale has matured. We think we are in peak. And I will go fast on the facts. So if you look at the oil market in the past 2 years, it has been more or less well supplied. So you see up or down, more or less not oversupply, not undersupply, and prices between 70 and 90. So very, very good market for everybody. Crude inventories are low, 0.2 billion. Effective capacity means taking the 5% that I use, you take 1%, which is not really effective spare capacity. If you use 4%, which is, I think, is Bernstein and IAA, let's do the numbers quickly. Demand, 1 million per million barrels a day per year, 3 million to 25, 6, 7. Supply, spare capacity, we take 1.5, and non-OPEC, 1.5. So OPEC plus 1.5, non-OPEC another 1.5 in the next 3 years, taking an average of more or less 600. Spare left in 2028, 3 million barrels a day, 2.8% of the total market, which means this is the level where, boom, this is the level where every time we reach 3%, prices spike, because we know that there is a problem in supply. And this is the numbers we do for the next 6 years in order to incorporate declines. So is 2024 production 103 million barrels a day, declines 6 years at 5%, more or less 17 million, demand 6.6 million. We more or less identify 8 million barrels of new supply that I don't believe in. I don't really believe that these 8 million will come of new projects. Even with these 8 million, the supply gap is massive. So, you know, for us, and this if everything goes well, and I'm using 3% decline, so, you know, being conservative here, it's going to be a disaster. And this is a way to see it. When the market is well supplied, like now in the past 3 years, you see the left distribution. Prices are around $80, and then you have ups and downs, demand, supply, wars, blah, blah. When the market goes to undersupply situation, like we will see in the next 5 years, I don't know when, maybe 2028, to say one number, we will go to the right distribution. And here you see 130, 140. 130, 140, why? Because at this level, the impact of the energy cost is so high that GDP starts to go down. So this is why at 130, 140, there's a barrier, because the oil price cannot go higher because, you know, it hurts the economies, then demand slows. Sector is super cheap. To make it easy, it's trading at 5 times EV/EBITDA, historical 8 to 10 times. Our valuations, we know, you know that we are obsessed by valuation. We have DCFs for everything. It's like 15, 16 IRR on using 80 oil and 3.5 gas. So we are getting 16% using 80 oil and 3.5 gas, and we think that this will be really much higher in the next some X years. I repeat a little bit what Alex said and Urs on the oil to gold ratio. It's all-time low. I think this is a century. So I'm not entering here. I mean, I have my view in gold, but this is a presentation on oil. This has to change. And look at the, you know, the perception is everybody is negative. Conclusion 1, everybody is bearish because of the electricity transition. Everybody is bearish because there's a spare capacity in 25 and 26, and OPEC Plus is back. And then macro, everybody is bearish because macro is weak. But the reality is we need new projects for 28. We need incentive price to have these projects. Oil prices will move there and higher because you don't have time to bring these projects even if you start now. The world has lived on shale for a decade, and this is now mature. We need to find another shale because, you know, we have $80 price because we found a new resource, shale oil, that was not there. Now we need to find another one. Imagine what would have happened if we wouldn't have shale oil. Oil prices would have reached 130 in order to just find oil in all the marginals reserves. And we have done massive EORs, what enhanced oil recovery. You know, they shoot water, they shoot chemical, pressure, everything they can in order to anticipate the curve. And a lot of people tell me, why are you investing in oil now? Wait, because you have your view that this year is bad, next year low prices, blah, blah. Well, this is the reason. They are very cheap. I'm getting 16% with mid-cycle prices. Free cash flow yield on average in our companies, this is a number that I do, is 10 to 12% at current prices, so I can wait. They are giving me 5-6% dividend, they're buying 4-5% buybacks, so I'm happy to wait with a 10%. We invest over the long term, obviously, so now is the time to buy when everybody is negative. And then imagine that we are right and Brent goes to 130. We're going to make a ton of money because these numbers are done with 80, not with 130. And then we need to be invested because in the end there are many options that this can be accelerated. I don't know, if the economy starts growing, if there is a war in the Middle East, if there are problems in Venezuela, Russia, Iran, Nigeria, so important production countries are having problems. Then imagine that the decline in shale we are using is too low because nobody knows. This is new. The decline in shale without investing, this is a new thing in ESG, you know. So there's a lot of, an M&A, we are seeing a lot of M&A. People are not stupid. I mean, we saw M&A in mining and in energy, and it's happening. So in the end, there are a lot of options that may accelerate what we think can happen in a couple of years. Anyway, we can wait at 10, 12% per year. We can wait 5 years. So that is for oil. Let's go to copper. This is easier. This is easier because both sides, so this is consensus. In oil, we are against consensus. In copper, we are with consensus, and we like it. Supply. I'm not dividing now what is more fundamental or short-term. So grades, underspending, all the new mines are smaller and more complex, riskier jurisdiction. You need to go to Congo to find new copper. ESG is again an issue here. It's for the whole sector. Sector is more disciplined. They are not investing as in the past. So if they don't generate cash flow, they are not investing, not like in the past where they were investing, creating downturns. We'll take a look to brownfields. Brownfields are mines that you're expanding. So the mine is there and you expand it. Greenfields are new projects, completely new projects. And we'll look at the new production. The visibility in copper is higher than in oil. We have a list of projects, so more or less we can track which projects and when they are coming, more or less. And then I'll show the project list, which I think is a wish list. Grades. I mean, this is like depletion, right? They have, I mean, this is a fact. 1% grade in 1980, 0.6 in 2020, and most of our mines, they are 0.3, 0.4, 0.5, and it's getting worse, it's not getting better. So this is a structural issue. Underinvestment, so you see that without the investing, you have the natural kind of decline with the grades, blah, blah, and the depletion, and you see more or less the investment in expansionary target for the last 5, 6 years. So it's not at the peak. It's not bad, but it's below what we should have. So lack of investment, the lack of investment since 2013 is applicable to the whole sector. This is the required investment for the next 10 years in order to meet demand. And you can see that if you add up all the investment, we need $200 billion. $200 billion, at what return? At what return would you ask for investing in a 10 billion mine in Panama that gets taken over by the government when you put the mine in operation? What is the cost of capital? Smaller and more complex discoveries. I mean, you see on the right hand, you see how the amount of tons discovered, the trend is clear. And on the left, you see the biggest mines that we found lately. You have Kamoa-Kakula, you have Cobre Panama, but I cannot really see resolution, which is not working yet. I mean, you cannot really find big findings because there's no. And then the same as in oil. So you're moving to, well, ESG. So mining, you know, environment, you are digging a huge hole, the trees, the animals, etc. So you have a green opposition. Then also you have resource nationalism because copper is strategic, and now the US is, you know, moving to declare strategic this and that commodity. You have a lot of disruptions, etc. So, you know, there's a lot of risk on ESG, geopolitics, and you're moving to more complicated jurisdictions. So now you have Congo, you have Zambia, you have Russia, Peru and Chile, which are less risky, but also they change the fiscal regimes. But overall, you're moving to riskier places. And then you see the project approvals on the right hand, you know, it's going down. It's going down. It's going to be difficult to build new mines, very difficult, more if you get taken, you know, by the government. This is what I was saying. The sector is more disciplined, which means that the price needs to go higher in order to incentivize these guys to generate more cash flow and invest. Brownfield projects, just I wanted to show that more or less we can track the brownfields. So this is what is going on with the intensity and with the number of projects, and you have the names. And if you put that in a different chart, you can see how much production, if all these big projects come on stream, and you go to 2030, not more, but 2030, I get 1.5 million tons more from brownfield. This is the greenfields, the same thing. And how much comes from the greenfields? Another 1.5 of 2 million. Even if I put 2 and 2 million, this is 4 million barrels. 4 million tons of copper. And we will enter then on the supply-demand equation. So just remember these 4 million of new production or new mines that are in the list with no risk adjustment, but 4 million. And then I go to the list, and because we've been here 20 years, we know some of them. Pebble is Northern Dynasty. They don't even have the environmental okay from the US. And probably they will never get it because they are in a very rich environmental area. Resolution, huge mine in the US, BHP, and I think it's BHP and Rio. They are pushing the US government, but it's going to be difficult. Reko Diq is in Pakistan. They don't get even the funding. El Pachón is a mine of Glencore that is in Argentina, but is close to the border with Chile. So they need the approval from Chile to send the tons, which means that it's going to be very difficult. They need, to pay a tax to Chile or something. Bamiskaya is in the US. This was a company that we used to have. Cash Minerals and was taken over. Taka, this is Chile, it's Argentina. First Quantum is not even in the list of the mines that are going to come, so it's not even, they don't have even FID, final investment decision. And Mason is for Hard Bay, they don't even mention it in their presentation because it's a project for 2030 more. So, you take the list and say, wow, there's a wall of mines coming. And when you understand a little bit the sector, you see that 1/3 is fake. They're not coming. And it takes a lot of time to build, so this is important in terms of timing. If the copper price moves up, you cannot bring the mine now. It's going to take full process, 16 years, construction, FID plus construction, 4 years. I don't know, let's use 6, 7 years. If we need copper now, it's going to take 6 years. So prices will go really high because it's very inelastic. Copper is a very small part of every cost, a house or a car. It's a very tiny part of it, so elasticity, it's very elastic. Demand growth, this is easy. I'm going to accelerate here. Demand is going to explode because of electrification. Let's try to time it in the next 5 years, more or less we can see it, is from 32 to 39, 7 million. 7 million more demand tons, 7 million tons. We were talking about 4 million using the pipeline. So there's a deficit of 3. Only in the next 5 years. And this is 2040. I mean, this is really nuts. It's crazy. We will need, so mine supply 23 million tons, and scrap, recycling, another 6. So to make a broad numbers, is 30 million tons. We will need 60 in 2040, with numbers from Glencore, basically electrification of transport and power. Forget, I don't know, we will need to substitute copper with aluminum or something, or gold. Deficit before 2030, so same story. Low inventories. We have 6 days of inventories. All-time low, right? So low inventories, average 11, 12 days. Yeah, it's not massive, but now we are at 6. What is the downside? It's always important to ask ourselves about the downside, and the downside is the marginal cash cost. When there is oversupply, you go to the marginal cash cost, and now the message here is that marginal cash cost has gone up a lot. And basically, we're talking about more than $2.5 a pound. The price now is 4.5. So I should have said earlier, the spot price of copper is 4.5. And now the downside could be, I don't know, if there's really a big recession, we could go to 2.5. And at this point, we should buy like hell. The second message is this marginal cash cost is moving up, and our numbers, this is going to be much higher than this 2.5. And if you add sustaining capex, so cash cost plus maintenance capex in order to keep production flat, you already go to $3.5 a pound. We are at 4.5. So when people say copper is too expensive, it is not. The supply-demand balance, with more or less visibility, So initially there are mines in 25 and 26, and then you start to have a problem in 27 and 28. So this is grossly more or less our opinion also, it's consensus. The problem is the long term, you know. This red line is the deficits. We need more mines, and fast. So if you need a mine, you need to incentivize the mine, you take the curve, you try to find what the new mines are, here is by countries, and you calculate what is the price they need to make a double-digit return. I'm not going to discuss this return, but basically, more or less the 90%, which is where everybody stops, 90% of the curve is $5. If you go to the marginals, it's $7. So as we will need everything, our base case is that these $7 will be seen in the next 2, 3, 4 years. And intensity is moving higher, so this is important. You see over the years, the capital intensity of a mine is growing. So per ton, you need to invest more. Let's do some numbers fast. This is, I think, is Woodmac. Their estimate of life of mine capex intensity is $26,000 per ton. I'm going to pounds. I'm used to pounds. So you divide by 2.2 is $12 per pound of investment per pound. You want 15% return, no, for Congo or Panama, or more. I don't know, 15, 1.75. So you need to make 175 after taxes, but you need to pay taxes. And these sector taxes are high, 50%, another 175. You add cash cost, you add depreciation, you need 6.5. 6.5, it's amazing. Okay, this we know, 16 years to build a mine. Conclusion, limited supply, like in salmon. This is something that we like in our fund. Massive acceleration in demand. This is a difference with oil. So here demand will surprise on the upside, and the Chinese know, and they will build mines, buy mines, and do whatever they need. The pipeline of projects, which is more or less visible, is not enough. So incentive price, but it takes time to bring a mine. So we have a decade plus cycle ahead. And we are more or less exposed, I think it's 20%, but I think there is detail here. So I need 5 minutes to make a little bit of advertising of our fund, our investment process. You know us, we are the 4 Gs guys. Good assets, good managers, good balance sheet, and good price. So this is a mantra more in this sector. Never go to leverage companies, never in commodities, because you may be wrong in the macro cycle, and then you get killed if you have debt. So it's even more important here than in the value global to don't have debt at any level. And good managers, normally they lie because they need capital, so they are big liars, and you need tier 1 assets. You know, you cannot imagine how, I mean, they lie massively because they need a lot of money, and you need to stay there with a, you know, poker face. Natural resources specifics, longer term approach. I mean, you as investors, you cannot invest here on a 2 years view. We are here to double and double in the next 10 years. Safer geographies, no startups is too risky. This is for venture capital, too risky to be outsider in a startup. You don't even know what is going on. Avoid majors because they are too big, they cannot really grow, and then they go to green energy and stuff like this. We invest in companies, not in commodities, because the commodities do the reinvestment. The companies do the reinvestment. The commodities is just the price play, so you can compound. And volatility for us is a friend. For everybody is an enemy. We like volatility. When copper goes down, we buy. When salmon goes down, we buy like hell, and we sell when it's up, and we try to do the same in order to enhance a little bit the yield. Our investment process, we focus on scarcity. Salmon is the example. So salmon is scarce. Supply is not growing as demand is. So the adjusting factor is the price. Where we are in the cycle, we monitor 3 cycles. So the trading cycle, the macro cycle, and the long-term investment cycle. And we more or less know where we are. We are obsessed by valuation. Anyone can ask about the IRR and what the numbers we use. And we have converged models. And we don't listen too much to experts. We listen to them, but yeah, I remember with shale oil, we had a very bad experience with, you know, listening to 10 geologists that told us that shale oil will never come to the market. This was the conclusion after talking to a lot of geologists back in, I don't know, 2012. This is our positioning now. This is the top 10 holdings. We are less concentrated than the value fund because you have more risk in these businesses. So we don't want to have more than 5% in a company. One day to the other, the government here comes and says, well, now taxes from 50 to 80%. So we are a bit more diversified, but you see the main drivers in the next few years. Salmon now is a bit more, but I don't know, 15 to 20. Oil and gas is 1/3, a little bit in oil services, and copper. So these three will be the big drivers now, but we also have uranium that we have been selling. We have mining services, potash, blah, blah, electric cables, and we try to basically diversify the fund a little bit, energy, metals, infrastructures, agriculture, in order to be able to have levers when the macro is negative, as we have done. I'll try to show it. So concentrated and diversified. The current situation is not good. Slowdown, macro slowdown and commodities normally are very correlated. So if the macro is bad, the traders will short commodities. But the fund is doing okay due to this diversification. Last year we were up 8%. This year, year to date, we are up 3%. So we are outperforming also the benchmark by 6 points. So we are happy in a difficult environment for commodities. So yeah, we keep investing. Nothing to say here. The moment which the market will anticipate the recovery, probably end of this year, next year, because Fed will cut rates, Europe is cutting rates, China is putting more money. At some point, the world will recover a little bit of acceleration. This sector probably will resume the bullish trend. And this is, as I said, this is going to be a 10 years plus. So, we need to be patient. Our performance, 5 years, 18%, as Alex said, so nothing really to say. Also, bear in mind that this starts with the COVID. So the sector got a hit in 2020, and this is why we've made almost 20% per year, more than doubled. But this keeps us very happy. This is 10 years, since 2015. So here you had a very bad cycle, first 5 years, then the COVID, then a relatively good cycle. We are able to make almost 10% per year. So this more or less keeps us happy that we can manage the fund even if the macro scenario is not as good. So we're kind of navigating the macro, and when the cycle is there, we should make a ton of money. Valuation, a lot of people tell me, well, the commodity cycle started in 2020 or 2016 and blah, blah, it's time to sell. Obviously, we have doubled in 2020, but it's an easy number. Materials and mining, 14 times PE, average historical mean 20 times. Energy, PE, 12 times versus 16. More important, the price to book, 1.6, 1.7 versus 2. If I take my book value of the fund, which is the average of the book values of the company, is 121 for 26. I apply the historical average, is 2 times. The fund should be at 240. We are at 156, I think, 156. So we have still a long upside to the mid-cycle. If we go to the bull cycle, where the price to book is 3 times, we should be trading at 363 if the cycle of commodities goes our way. So we should multiply by 2 point something. And this is the look-through of the fund. PE, 26, 12 times. The most important is a 1.3. So I'll tell you, in my experience, the sector average is 2 times mid-cycle. We have 1.3. We need to make, hopefully, a good performance in the next few years. The average return of the fund, calculated as a weighted average, is 15%. The intrinsic value on convergence, which is the average of the intrinsic values, is 250. We are now at 150 something. And yeah, we are not, these numbers do not include the upper part of the cycle. So all our models are in convergence. And final slide for me, we are looking for long-term partners. We invest in the companies, we invest in SalMar for the long term. We want also investors for the long term. We are invested in our funds in the long term. And you can count on us to be as transparent as we want, as we can, and then do our best effort. I think that's for me.